Bloomberg Audio Studios. Podcasts, radio, news.
Here's the latest this morning. Trade talks between the US and China stretching into a second day as President Trump's Friday deadline approaches. The Commerce Secretary Howard Lutnick saying a 90-day truce extension with China is likely. Mike Wilson of Morgan Stanley is bullish, writing, "We're bullish into 26. Through the near term, setup is not without risks. These include tariff-related inflation." Mike joins us now for more. Mike, good morning. Good to see you. You list a lot of reasons to be constructive here. Just go through those reasons for us this morning.
Yeah, I mean, the reasons really haven't changed. I mean, we've been very constructive since May when we did our mid-year update. And I think the main thing to take away from our outlook that's maybe different than others, I think we came into the year feeling the first half would be tricky, second half would be better. And that was all a function of the sequencing of the policy, right? So the policy sequencing was what we said. It's a kitchen sink the first quarter. They did the growth negative stuff first, and then it flipped very quickly in April. So the main reason we're bullish, okay, is that the earnings revision breadth, and we show this every week in our note, and it goes up every week, has exploded higher off of what was, a deep cyclical low that basically priced in a recession for the most part. So that revision breadth is guiding us to the performance that we've seen. This is, just to put it in context, okay, this increase or V-shaped recovery in earnings revision breadth is as significant as we've seen since COVID, the COVID recovery. And that was the last time that we were this far out of consensus being bullish. And it was right because of it's the data. We're data dependent. So that's the main reason. So this is not just me saying, momentum in stocks and price momentum, et cetera. That's part of it too. So what's driving that earnings revision breadth? Well, first it's the reflexivity just on people getting too bearish on the growth negative stuff. And let's not forget the AI CapEx cycle, which we came into the year feeling negative about, also bottomed in April. Okay, so those are two big drivers. The second one is a weaker dollar. Okay, weaker dollar is a big tailwind for multinational companies. Okay, and the third one now is we're starting to see operating leverage in more companies across the S&P 500. And this is a very unique view that we've had. So the rolling recession call that we've kind of been talking about. Well, now it looks to us like we're having a rolling recovery. Okay, and that will be further spurred by the Fed cutting rates at some point in the next year. Now, we don't know exactly when they're going to start, but I think it's fair to say that they're not going to be raising rates. So this 3-year, what I would call soft recession that we've been living through now, we're sort of coming through that, and we're getting more visibility on that. That's why we're more constructive on the next year. Now, in the next 3 months, I do think that some of the things that people have been worried about could start to play through earnings. For example, we can see cost of goods sold increase because of the tariff. The inventory now is flowing through the cost of goods sold. We can see the back end of the Treasury market start to back up again because of the supply that we know is coming. And then, of course, we still have to deal with just this sort of concern around inflation and how does that play through and how does the Fed respond to that. So there are risks out there. We're not saying there's no risks. And remember, the market trades 6 months in advance. So that's what's happened. The market has figured this out. It's gotten ahead of it, and we've priced a lot of good news.
How much is this entirely tech-driven versus a broad-based kind of revisions, increase, and recovery, given some of the mixed guidance that we're getting this morning from a number of companies, particularly those that are consumer-facing? That's
right. Well, it still remains mixed because we're still in this rolling recovery, right? So it's not everything at once. Tech and the Mag 7 are leading, but we're seeing also other groups, industrials, financials, okay, software, which has been in a soft recession for the last couple of years. We are seeing a broadening out for the Mag 7. So it's not where we need to be to say, we're going to move into small cap stocks, we're going to move into the low quality parts of the market. We're still staying up that curve. However, it's starting to progress, just like the rolling recession saw a degradation that was kind of not all at once, but kind of more piecemeal.
So during the rolling recession, we saw gains of about 20% on the S&P 500 for a couple consecutive years. Could you see gains of 20% or more during a rolling recovery? Does it matter if you're in a rolling recession or rolling recovery in terms of the returns?
What I would hope is that we would see areas that have been lagging start to participate more. And that's sort of our view on 26, right? And that's sort of starting to happen now. But industrials has been the best performing sector year to date. It's been our top pick for the right reasons, for the reasons that we've been citing, which is earnings there are starting to look better. And let's not forget the tax bill, which I didn't even mention earlier. This is a massive, tailwind for cash earnings for U.S. companies. I mean, to the tune of 5 to 10% increase. So that's real money going into the pockets of companies. They're now allocating capital, not the government. And I think everybody would agree that that's probably a better outcome.
Do you think U.S. exceptionalism is back? Is everyone else signing up to that?
Well, what I would say is that maybe U.S. exceptionalism has been missing. Okay, so now, I mean, no one wants to admit this, but the direction we're going in now, it looks like we are going to see better participation across the economy. we've been waiting for this. We've been waiting for this for 2 or 3 years. We've been kind of back and forth, sometimes bullish, sometimes bearish, trying to pick stocks. And this is the first time I can say that I can now see the path of this transition where we're actually starting to rotate into more of an early cycle recovery.
Let me give you some more space to do this because it's important. The strategy of the White House and the rebalancing that you envision a year out, 2 years out, 3 years out, what is it you see?
Well, the rebalancing is both global and domestic. So the global rebalancing is obvious. They're trying to reduce our current account deficit, get, the trade negotiations are along those lines. And I think that's right. I think that's a good strategy, getting more manufacturing potentially in-house or domestically. In the domestic rebalancing, it's really, instead of just having the 1%, right, is, Main Street over Wall Street. I mean, people say, well, that doesn't sound like that's working right now. But the idea here is you get lending through the regional banking sector. You get lending, smaller banks lending to small businesses, to individuals, get rates down at the back end. Okay, that will liberate actually the domestic, the sort of the middle part of the economy.
Where do you then place this idea that tariffs are pretty regressive? This idea that lower income individuals bear the brunt of it because it's essentially a sales tax on them, and you're already seeing companies really grapple with what that means for demand, particularly in the travel and leisure space. How do you square that with the sort of broad-based dynamism that you're talking about?
So I think it's very simple in the sense that you have to think, okay, what do you have to think about? What are the tariffs trying to achieve? My view has always been that this is going to end up being an import tax. Now, I would have said, 2 weeks ago, this is a 10%, it's going to end up at a 10% import tax that's going to be shared between exporter, importer, and consumer. And the market will determine, okay, who can absorb those tariffs. Exporter will decide, hey, we got a discount because we're going to lose volume. Importer will say we can't pass it on, we're going to eat some of that. And the companies that have pricing power will pass it through. Okay, now we believe that the consumer areas have less pricing power. So I would argue that the pricing power is going to be more probably in the industrial space, probably more in the, sort of the value-added supply chain. So then what do they do on the other side? Oh, they do a tax cut for the companies. So it's just basically saying we're going to tax this chain here, which is going to be a shared tax, but then we're going to actually give that away to corporations who can then reinvest and actually get the economy moving. It is a capitalist type of approach. Now, I don't know if it's going to work perfectly, but I like the direction of it. From an investor standpoint, I love this. Okay. Now, I'm not here to make judgments about who gets hurt the most or whatever, and I don't really know, but I can see the path and why we're more constructive, why we've been more constructive on the 12-month view. I think, remember last year you said, Mike, this is the first time I've heard you sound a little more constructive because I had that vision.
It's overwhelming this morning, Mike. I've got to get to a break. We all need a break. Mike Wilson of Morgan Stanley. Mike, appreciate it. Thank you, sir. It's good to see you.